Alright, so basically this is a break-even problem. Alex and Chris run a company. They're making and selling tennis rackets. They sell the rackets for $80. Their variable costs to manufacture are $30. Their variable selling and admin are $10. Their fixed costs are $5.50. So what's break-even? Well, the formula for break-even is fixed costs plus operating income divided by contribution margin per unit. Okay, so our fixed costs are $550,000. Our operating income is 0. When we're trying to break even, we want, our revenues to equal our expenses. And we're going to divide that by our contribution margin per unit. So what's our contribution margin per unit? Well, it's our revenue of 80 minus our variable costs, right? Our variable costs are 30 and 10. The 30 and the 10. So that gives us a contribution margin of 40. So 550,000 divided by 40 gives us 13,750 units or rackets. That's how many we have to sell to break even. If the company increases sales by 100, how much will this increase operating income? Well, this is pretty easy. We don't actually have to go through and do all of this calculation here because that's the beauty of the contribution margin. The contribution margin times the units is our increase in operating income. Because our fixed costs don't change, so the 550 don't increase when we sell 100 rackets more. And our revenue minus our variable cost is our contribution margin. So we have additional contribution margin, no additional fixed costs, so that becomes additional net operating income. Alright, what if they want to, companies aren't in business to break even. What if they want to have a profit of 150,000? Well, again, we go back to this original formula, and it's fixed costs plus operating income. So our target profit of 150,000 divided by our contribution margin, need to give myself a little bit more room there, divided by our contribution margin of 40 is what do we have here? We have 700,000 divided by 40 equals our break-even has increased to 17,500 rackets. So it was 13,750 to break even, but to make 150,000 in profit, we're going to have to sell 17,500. Finally, this last problem is could be a little bit tricky. Let me just show you how we would solve this. We have two things changing here. We have contribution margin is decreasing and fixed costs are decreasing, and so we're trying to figure out, well, which is better? Is it if our contribution margin decreases, that's usually bad, but if our fixed costs are decreasing at a faster rate, then it might be good. So let's do some math here. So remember, our revenue is 80. Our variable costs are 30 for manufacturing and 10 for admin and selling. So that gives us a contribution margin of 40. But that's if we're making it in-house. If we buy it from somebody, they're going to charge us $35. So that replaces this number here. So our revenue would still be 80. Our variable cost, instead of manufacturing, would now be purchasing, and that's 35. And then the problem tells us that the variable and admin remains the same, so that's still 10. So now we have new contribution margin, and it's 35. It's no longer 40. So our contribution margin is decreased. But our fixed costs have dropped 200,000. So instead of 550, right? Instead of 550 break even, it's now 350 of break even, right? And break even is 0, and let's just figure out break even. And now instead of the 40 of contribution margin, it's now 35 of contribution margin. So we divide that out, and actually we now only have to sell 10,000 rackets to break even. So yes, should they continue to manufacture their own rackets or purchase the others? They should purchase, because it lowers their break-even. They're going to break even with fewer sales. And this is the calculation as to why they should do it, and the explanation is it lowers break-even, so they'll be more profitable. I don't know, something like that.